Dave Reeves, Managing Director, Calidus Resources. Calidus is operating the Warrawoona gold mine in the north of Western Australia, and will shortly be turning on our second project at Nullagine, also in the north of Western Australia, taking our production in excess of 100,000 ounces per annum.
David, good to see you. Right, Nullagine. Well, let's start with that. So that's coming online. What's that going to do for you?
Yeah, so Nullagine is a project we purchased in December last year. When we announced Nullagine, we could announce a historic resources of about 1.4 million ounces out there. What we've just done is start signing off on those resources ourselves. So we tackled a couple of deposits. We just announced 500,000 ounces that we can freely talk about. And there are a couple of deposits we want to target upfront for the mill. So there's a full mill there, 1.8 million tonne per annum mill that was only shut down a year and a half, 2 years ago in really good nick. Won't take much to dust that off and get it up and running. And all the other infrastructure you need, camps, power stations, etc. is all there. So what we're doing is looking at restarting two old mines, one called Beaton's Creek that's still got in optimised pit shells somewhere around 250,000 ounces, and another deposit called Barton's, which was an underground that was being mined previously by Millennium, producing about 25,000 tonne a month at 2.4 grams when they were producing. So our plan is just start slowly. We don't get a mill 2 weeks on, 2 weeks off. We don't need to fill the mill. What we're trying to do is produce unhedged ounces, take advantage of this high gold price as quickly as we can. And so, our target is in that 30 to 40,000 ounces per annum coming out of Nullagine in the not too distant future to add to our 60 plus that we're currently doing at Warrawoona.
Okay, well, let's look at that. Okay. How much do you pick that plant up for, or that one the asset for?
Upfront consideration, 250,000 Aussie, deferred consideration on, I think, 100,000 ounces produced of about $5 million.
Considering what it had been purchased for previously, that's a heck of a bargain there. And how much more work to kind of get it up to spec for what you're going to run through it?
We're certainly talking for the mill. Look, we'll put this all out in the feasibility, but 2-3 million. There's
2-3 million. Okay, that's sort of quantum. Yeah,
it's not a lot. It's in really good nick.
Right, and again, so considering what the previous owners were trying to do with it, it wasn't kind of fit for purpose. And in terms of the ore bodies, the ore that you're going to be putting through this, what's that look like? You've done any work on that?
Yeah, so it's all free milling. So that's what this plant is. It's just a conventional gold mine. Crush, mill, gravity, CIL, and both of these deposits we're targeting are just free milling deposits.
Right, and I guess on their own, both those targets, they are small. Probably, if it was a standalone, probably really wouldn't stand on its own 2 feet. But for you, this kind of going in and picking up these sort of additional ounces, what's that do for you? Because we talked a lot and ad nauseum about balance sheet and hedging and debt and so forth. Why pick up these and go for these kind of smaller asset? What's it do for you?
Yeah, so look, by picking up the asset, what we liked is we already had a deposit in the region called Blue Spec. So we've now pretty well put our foot on every deposit in the East Pilbara, and it's how you move the pieces of the puzzle around, where they go to, which mill. It just gives us huge flexibility and upside, so that's why we liked it. And also the fact we got $14 million advance payment for leasing the camp out the next day on our 250,000 purchase. But why we can and why we want to turn on the mill like it is, as you rightly say, if you had this as your only asset, what you'd probably be doing is drilling out for a couple of years, getting to 1 million ounces of reserve before turning it on at 100%. But it did have issues back in the day that I think need to be acknowledged. The first thing was there was a bit of a struggle for water when they were trying to run it full time. So by running it 50% of the time, that is without a doubt not an issue. And we can look at the water over the next couple of years. Should we want to run it at full capacity? Because we don't have any debt, because we don't have any capital tied up in it, we're not trying to maximise the returns to pay off debt, etc. What we're trying to do is just get cash flow now. We've got, a situation with our hedge and our debt over the next 18 months we need to sort, and this provides, a massive boost in cash flow for us because it's all unhedged.
Okay, fantastic. So it's a way of kind of getting after the balance sheet issues, which we've talked about, and the hedging, etc. Okay, understand. Just sticking with the plant for a bit. Obviously picked it up cheap, which is fantastic, and these kind of like satellite feeders, or kind of good news for you. And it's cheap to $2-3 million. It's fine. What happens when that runs out? What else are you going to be feeding this with in the future? Just going to look into the future.
So this is what we're trying to do, and what we said in the announcement is just an initial resource for the first couple of years.
Yeah.
So if we look at, say, Beaton's Creek, we're only looking at 50,000 ounces coming out of there, but there's another 200,000 ounces in a bigger pit that just needs a bit of permitting. So that's an obvious target just to roll into and potentially put the mill back to 100% capacity. The Bartons deposit is open at depth, but more importantly, we believe there is very strong evidence of a high-grade chute that hasn't been followed. They just went directly down dip instead of following the high-grade chute. So we'll be chasing on that. When I haven't even tackled the main deposit, which is called Golden Eagle, which is right next to the mill. There's probably a cutback 20-25% complete to get another 120,000 ounces there that we haven't looked at yet. And there's another 16 deposits on top of that. So we see a huge potential there, plus our own exploration north of there called Felix we found a couple of years ago. We need to do some drilling, but that's the largest soil anomaly in the whole region. And we had some fantastic initial intercepts, I think sort of 45 metres at 2.5 grams, things like that, so near surface. So that mill will be kept busy for many years beyond this first two, but we just wanted to get up and running and get that cash for our balance sheet.
Okay, great. And we'll come back to exploration in a second. So with regards to, obviously, producing from two sources, fantastic for you guys. You said these will be unhedged ounces, and that's a big deal for you in terms of margin, because it comes down to margin and, I say, sorting out that balance sheet. So what is that? So in the range of what will you be able to announce to the market, or have you announced to the market?
Sorry, maybe.
How much money are you going to make?
How much money? Oh, look, I think you've got to look at what average sort of mining costs are, and if you're making $1,000 an ounce, you'd be pretty happy. 1,000 to 1,200 an ounce on that 30 to 40,000 ounces. That's the sort of range we'd like to make to kick off with.
Right, remind me, and you'd be looking to bang out what each year?
So 30 to 40,000 ounces.
30 to 40. So say 30. Okay. So that kind of gets you going for sure. That gets you going for sure. In the meantime, what's the balance sheet like at the moment in terms of what's available to you?
Yeah, so the balance sheet is always slightly under pressure. We are paying off our debt and our hedge book as quickly as we can to get rid of them. So our hedge book we've reduced by over half to 73,000 ounces at the end of this quarter. By the end of the year, we'll be down into the 50,000 ounce mark, boosting production to 100,000 ounces next year. So suddenly the hedge becomes a lot less invasive as when we turn this mill on. Cash wise, I'm trying to remember what we had at the end of the last quarter. 12, yeah. So we're not going to be adding to that because we're paying off debts and getting rid of hedges, and maybe we'll add a little bit this quarter. But it's all about getting rid of the debt, getting rid of the hedge, because at that point life changes dramatically for us.
I mean, I don't want to go over old ground here, but just, I guess, for new people leaning into this one, so I guess it was different times, right? It was different times. It was kind of we're pre-COVID, supply issues and pre-inflation, etc. But why did it make sense at the time to have the hedge?
So it was a mandatory hedge for us to borrow $110 million. It was insisted by the bank that we have it as downside protection. At the time, gold was $24.50 an ounce Aussie, heading south a little bit. $23.70 didn't seem altogether bad. COVID came along and suddenly we saw inflation. Our mining costs are up 50, 60%, if not a bit more. in that period. And when I say ours, that's across the industry. So you've seen massive cost inflation above what anyone could have predicted. And unfortunately, we've got that hedge in place that means that we're not seeing the increase in the gold price coming through. But, we are over halfway through that hedge now. So we feel like we've sort of broken the back and we're on a downhill slide now, and it all gets easier. We've broken the back on the debt as well. So our interest bill's coming down. So there's, we certainly feel it's been a struggle, no doubt, for everyone involved the last couple of years. And we've still got another 18 months to get through this, but we are increasing production compared to the last 24 months. And we've got a lot better gold price for the unhedged portion. So, we certainly feel that we're in a lot better position now, and especially when we turn this plant on, than we have been in for a very long time.
I know you kind of refinance the debt. I certainly had conversations with Macquarie with that previously. Would it be timely again to have, given what we're seeing in the market, and maybe given some of the restrictions on you with regards to the things that you want to do, like getting after the exploration, the kind of feed, Nullagine, could you have conversations again to refinance it once more?
Yeah, so we're always in discussions, working with them on what makes best sense for both parties. The discussion is, do we try and, we're in this increasing gold environment. Does it make sense to actually focus on the hedge and accelerate the departure of the hedge and roll out the debt a bit rather than the other way, which is more common? So we're constantly having those discussions. And it's a sort of dynamic beast depending on where we see the market heading, etc. So there will be some changes coming up amongst all of that. That will be a continual moving discussion, but it's in the best interests of both parties that is the outcome of those discussions.
Yeah, obviously, look, they don't want to put a stranglehold on you. They want to realise your potential, and they don't want to, likewise, to make it so difficult that, it's terminal, right, for companies. But at the same time, there's an opportunity here if you can have available capital to do the growth things that you want to do.
Oh, absolutely.
The growth expenditure, right? So,
yeah.
Okay, I guess we'll hear from you at a time, as and when those conversations, manifest.
Yeah, it's, to be fair, I think we need the feasibility done, the reserves done, the models done. As the banks look at the spreadsheets, and we need to have all of that tied up in a bow. And once that's done and it's fully costed, then that's when we can have those discussions on how we restructure at that point.
Right, and where are you in that process?
So the full fees will be out in the next quarter.
Okay, so close. So
yes.
So the next 6 months for you are quite meaningful in the sense that, one, you'll have got rid of a lot, a bunch more hedge. You're down in the sort of mid-50s range there. You've got the data that you need to be able to have conversations around the debt. And then you've got a choice to make as to whether you just tough it out for the next year, remove the hedge quickly, or maybe look at trying to, drive slightly more aggressively on the exploration front.
Yeah, lots of balls in the air. So we just got to, get that work done, make sure we are comfortable with the restart. Both mines have been mined before, which is great. So we've got full reconciliation. So we see it as very low risk. The mill's well known. We're re-employing the previous underground manager. We're re-employing the previous maintenance superintendent. People with a lot of knowledge of those two. So we are just switching back on mines. It's not like a new deposit. What's a reconciliation like? How's it going to go through the mill? These are well-known deposits. And that's, one of the reasons we targeted them.
Are they all... And they're all similar in terms of the ore bodies. That there's no sort of difficulties associated with processing.
No, they're all their own individual ore bodies, and they've all got plus 90% recovery, different hardnesses, whatever. So they've got different characteristics for sure. But yeah, like all deposits in gold, everyone is unique.
Right. No, I meant really in terms of the recoveries you said, and in terms of that whole metallurgy and the processing, the costs, etc. It's all pretty much the same. There's no complications there. Okay.
No, all 3 milling ore.
All 3 milling ore. Okay. So, I mean, we kind of talked about, and I honestly I don't want to go back over all ground, but it's just like lessons learned of this process. Do you think any of this was avoidable? Do you think there was a case of, well, actually, you and everyone else kind of got caught up by the market somewhat, or what?
So I think if you look at it and pick it apart a bit, the mill is operating fantastically at Warrawoona, above nameplate, good recoveries. The infrastructure's all working well. Got a great crew up there. Mining we struggled with, and I think that's both from a movement point of view that didn't help us, and there were
In what point
quite
of
a
view?
few.
What do you mean?
So
Movement.
the mining contract, we want to say move 600,000 cubes a month. We only moved 540 because of labour issues during COVID and scarcities thereafter when the
Water.
borders reopened. So we had those challenges. Could we have predicted them? Absolutely not. We had issues with the modelling of the ore body, which is why I'm very comfortable with these ones going into them. And we had 3 independent consultancies do their own models of Klondike, and all of them were incorrect at the end of the day. What could we have done better there? Very difficult to say. It's an estimate. Hedging, if we didn't hedge, we wouldn't have got the money from Macquarie. Potentially, we could have got the money from another source without hedging at a higher cost, which would have been in the longer term better for us. But we didn't. So look, I think the main thing is we are up and running, and if you look at developers today, there's 1 or 2 that get a lot of love. The De Greys, which are massive and what have you, but all of the other developers are really languishing at pretty well all-time lows, and God, it's going to be tough to get them financed up and running off their equity values at the moment. So, it's been a rough ride, but we're up, we're away. We see the finish line. We have broken the back of this. We are doing things to improve, such as bring on Nullagine, which is a step change for us, plus the other deposits like the Hamer joint ventures. So we have been very active in trying to improve our situation, and there is a point where that debt and hedge is gone. And wow, it's a different company then.
It is. And I guess you're the beneficiary of a really strong gold price environment at the moment, 3,500 Aussie, 2,300 US. And that can help kind of soothe or cover up a few issues with companies. But you will be producing more at the right time. I think and I think a few of the greats in mining say to me, quite often it's timing and luck as well. And I think you're probably going to tick off both those buttons, just boxes by being in production at the right time. And I do agree with you. There's a lot of developers, we speak to them, who are struggling with raising the capital now. 1, because it's not available, or 2, it's prohibitively expensive, and they will get spanked in the market for that. So, I guess well done for being lucky.
Some would say not too lucky with COVID and inflation, and it could have gone a hell of a lot better, and we'd have liked to have gone a lot better, but we are there. We are persevering, and we will always persevere, and we do believe we've broken it back. So, yeah.
No, I hear you, David. Look, and I will give you credit for that. You've moved forward in a market which was really, really tough for everyone. You did not get a lot of credit for that at the time, and I think even still, you're probably undervalued at the moment, because people just want to be able to kind of see line of sight to getting rid of that hedge, and then I say the margins come in terms of the end game. We've talked about the ambition that you have, and in terms of the ounces that you believe are capable and you're going to be capable of. And I know you've been ambitious with acquisitions and stuff in the past. Have you been kind of put off the kind of M&A route? Do you think organic will suit you better?
we've got our hands full with the East Pilbara now and all the options there, and we need to stick to our knitting, get rid of that debt and hedge, build the balance sheet. And with that balance sheet and our operating experience, if the developers still haven't moved from their valuations, we can build mines. We build it on time, on budget. And by having a balance sheet, suddenly your cost of financing, your requirements on hedging, all these other things start to fade away compared to a developer. And that really does open opportunities. But that is a long way down the road, Matthew. We need to first get rid of the debt, get rid of the hedge, build a bit of cash in our balance sheet, and have a solid plan on our own assets, for the medium term. And at that point, then we can turn our attention to that. But we're certainly not looking at anything now.